Hey everyone, welcome back to Upside Down Data. Today I want to talk about backtesting a strategy that incorporates multiple different models. I put out backtesting videos in the past, and in those videos I usually just focused on one model and backtesting a strategy for that model. So for example, the market direction classifier, which is one of the models that I'm going to be talking about today in this strategy, I put out a bunch of different videos in the past showing that a simple strategy just using the MDC can wildly outperform the market. But the idea is that sometimes adding different models together can lead to results that are better than the sum of their parts. So basically adding different multiples together into a strategy can sometimes yield better results than just using the one model on its own. And so what I want to talk about today is how can we maybe amplify the effectiveness of the market direction classifier with a second model. So the backtest I'm going to talk about today, we're going to start from roughly around here. And the model we're going to pair the MDC with is the forecast model, the probabilistic forecast model that I've been working on more recently. Now, the more I've been working on this model, the more convinced I've become that this might just be the holy grail of market models. It's really, there's nothing like this out there anywhere else. I haven't seen anyone make a model that's anything like this or be able to give the information that this gives. Basically, what this model does is it gives you the probability that the asset price will be up in 180 days in the future. So looking 180 days in the future, 6 months in the future, what is the probability that the price will be above where it is today? And so basically, if you're up near 1 or 0.9, 0.8, this is 80%, 90%, 70%, etc. percent probability that the price will be above where it is today 6 months in the future. That's how you can read this. And so if you're down below 0.5, if you're at 0.4, 0.3, 0.2, that would be only 30% chance, for example, of price being up at 0.3 or 20% chance of price being up in 6 months at 0.2. So that's the way you can interpret this. It's probability. So basically you just say this is 80% probability of upside in 180 days. This would only be 20% probability of upside in 180 days. And so I'm showing you here from the start of where the backtest will be, because this is the output that's going to be relevant to what we're going to be doing here. But you can see is that for Bitcoin, that's what I'm showing you here. It does a fantastic job, getting bullish at the right times when the market's going up, then getting bearish at the right times when the market's going down, bullish, and then most importantly, really identifying this big bear market well before it even happened, being very bearish, as the market was setting in an all-time high for Bitcoin. The probabilistic forecast model is only giving a 20% probability of the market being up in 6 months. And then we saw that it was able to call that very well. It got very bearish, and that's exactly what we saw. A big bear market ended up following. And now we're resuming a bullish footing right as the market, as at least so far, turned around. So this is a very powerful model. It works not just for Bitcoin, this works for all the different altcoins that I have tested it on. It's very powerful, very reliable, can log accuracy ratings of 90% plus. It's a really strong model. But as I mentioned in my previous video, I talked about where I backtested a strategy just for this model. This model on its own, in that previous video, I tested a strategy where you would just go long if you flipped above 0.5, short if you go below 0.5. That's not really optimal for this model because this is forward looking. This is looking 6 months into the future. And so even if it flips bearish here, that doesn't mean the market's going to necessarily flip bearish immediately. It just means that in the future, projecting forward 6 months or somewhere in that ballpark, there's a decent expectation that the market will be down. And so, of course, you can get some big movement like this in the meantime. And so basically what I'm going to be testing is a strategy where we use this forecasting ability of this model, and we combine it with the MDC, which is giving this critical level. So if you're not familiar with the MDC, this yellow line is the critical level, and price flips above that means that you're likely going to go into an uptrend. Flips red, you're likely to be going into a downtrend. And so this is trying to identify at the point in time when a trend is starting or beginning, when that's happening. So for example, when you're breaking down here, it's trying to identify in real time, when is that breakdown starting, or here, in real time, when is this uptrend forming? And so this is kind of a real-time indicator, whereas forecast model, in the name forecast, is projecting into the future. And so it's not saying that immediately things are going to break down, but if you look into the future, conditions are such that it's likely things are going to break down by that point in the future. So if we can combine this, we can get a sense of what should our outlook be. That's what the forecast is giving. So we have a bullish or a bearish outlook. Then the MDC is giving us in real time, when is it time to think that a trend might be over or a new trend is just beginning. So that's how we can kind of use these two things together. So we talked then about the backtest setup. We're going to have two different strategies we're going to compare against each other. So I'm going to compare an MDC only strategy. So this is going to be a strategy where we only rely on the market direction classifier. And so basically the way the strategy works is that you're going to buy the asset, in this case Bitcoin, when the price flips above the MDC critical level. So basically if price, going back over here, if price flips above the critical level, you get bullish, you buy. And then if it flips below the critical level, you get bearish and you sell. And actually, in this strategy, not only are you going to sell, but you're actually going to short also. So it's sell and short when price flips below. Whereas with the MDC forecasting plus forecast strategy, this is where we're going to combine the two different models. The way this is going to work is you're going to buy when the price flips above the MDC critical level and when the forecast model is greater than 50%, 0.5. So basically when it has a bullish outlook. So basically you're only going to buy when the MDC signal and the forecast model are in agreement. So when the forecast model is bullish in the next 6 months, and when you have a positive or a bullish flip of the MDC, that's when you're going to buy. And then you're going to sell and short when price flips below the MDC critical level and when the forecast model is bearish, when it is below 50% upside probability in the next 6 months, when it thinks there's it's less likely than chance that the market will be up in 6 months, basically. So basically you're looking for confluence. You're looking for situations where you get a bullish crossover on the MDC critical level, price flipping above it, for example, and the forecast model is bullish. And then you're also looking for points when you flip below the MDC critical level and the forecast model is bearish. So those are the two things that you're going to be kind of looking for together. Okay, so those are the strategies. So MDC only, very simple. The combination is you're looking for confluence across. So a bullish outlook plus a bullish flip, bearish outlook plus a bearish flip, basically. And so both strategies then are going to start with $1,000. That's the initial investment. The start date that I've chosen is October 9th of 2018. So basically about 4.5 years ago. And no training data is being used in this backtest at all. So for these models, it's only test data that we're looking at. None of the data used to train the models is being included in this. So this is what you can think of as being real-time output for this backtest. There's no hindsight bias that's going to be leaning in here at all. And then also, this backtest is going to take into account trading fees. So both fees for buying, but also fees that are involved with shorting. And then we're also going to be using daily close prices as the price. So that's going to be, it's daily closes that this is being tested on. Okay, so let's go ahead and look at the results. So here I'm going to show you first just what the MDC only strategy is able to achieve in that time. And it's quite impressive. You start at $1,000 and you're able to turn that $1,000 into over $10,000. So here I've done this, the increments on the y-axis here, by 1,500, increments of 1,500. So it's a bit over, it's around $11,000 basically is where the MDC only strategy ends up. Not bad, that's about an 11x in that time. And what's really impressive is you just look, throughout this whole time, 2022 to 2023, this is a big bear market. This strategy is actually going up. It's appreciating in value overall. But how does this compare to the MDC plus forecast model strategy, the critical strategy we're going to be talking about? Well, that one outperforms. So the combination of the MDC and the forecast model outperform the MDC only strategy and to a decent amount. You can see that this is getting up close to $18,000 starting from 1,000, about an 18x improvement, whereas the MDC only is about a 10x improvement. So notable difference. And again, the reason why this is possible or how this can happen is that the MDC strategy, it takes more trades. So, there's more flips than there. So basically there are a bunch of different flips that'll happen throughout this time on the MDC, but not all of them are the best opportunities. You don't necessarily always want to be buying and selling every single one to have the most optimal outcome. And so to be able to figure out which of those flips is most diagnostic, which are the ones that are the best entry signals and the best exit signals, turns out that combining it with the forecast model can help you do that. Because it turns out that the forecast model is bullish and you get a bullish flip on the MDC, that's probably an especially good time to be buying. If you get a bearish flip on the MDC and the forecast model is pessimistic, it's bearish, and that's a pretty good sign that you might want to be getting out of the market. And so you don't trade as often, and so you're not incurring as many trading fees as the MDC only strategy would, and that's partly why you're able to then go ahead and outperform. Now that being said, that's not to say the MDC strategy only is bad by any means. If we just look at the results, the MDC strategy only is about a 10.7x return on initial investment. The combination strategy is a 17.8x, so considerably better. But if we compare this to a buy and hold strategy where you just bought $1,000 worth of Bitcoin at the start of the backtest and just held it the whole time and didn't do anything, you would have only 4.5x'd your initial investment. So even though the MDC only strategy does not perform as well as the combination, it's still blowing this buy and hold strategy out of the water, which is critical. So this is the best return, definitely blowing the buy and hold strategy out of the water. The MDC only strategy is also good, but not quite as good. And so the main thing I wanted to just talk about with this video is that, in the past, I've mostly just backtested single models with individual strategies just for them. But there's a whole host of things you can do by combining these different strategies together that can actually yield better results. And so here, if we just look at these two models, they're both giving very useful output, right? The market direction classifier does a great job of identifying in real time when these trends are forming and failing. But not every flip on the MDC is a massive gain. Some of them are relatively small to the point where it may or may not be worth the trading fees involved to get in and out of those positions, especially if you're thinking about shorting and some of the fees that are involved with that. The idea is that by combining it with this additional model, in this case, the probabilistic forecast model that I've been working on, you can make the results even better. So MDC on its own will crush buy and hold, but it will do so to an even larger degree if you combine it with other data, such as the probabilistic forecast model. And so that's where I think the true power of the suite of models that we have developed here at the channel really comes into focus, is not only are these very powerful models in their own rights, but they're even more powerful when you start combining insights between the models together. And really with this probabilistic forecast model, I think this is an amazingly powerful model. I've been consistently impressed the more I work with it, how well it's able to perform and how well it's able to give us insight about what's coming in the future. And that can then guide us in how we might want to play some other models that we have. So obviously none of this is financial advice. You should form your own opinion about these data and what you're seeing here. But I think this is just an interesting way of thinking about these models, and I just wanted to share that. So if you like the content or subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, better indicators, and more over there. And check out our website, polaritydigital.io, where we have our models operating in real time.